Hello everyone. In the last video, we discussed about 4 steps how to judge the management. In this video, we'll discuss how to understand the company. Here, I like to break this down into 3 separate steps. Understanding the sector, analyzing their business model, what is their moat, their competitive advantage. First, understanding the sector and the subsector in it. Every company is part of a larger group and it belongs to a particular sector. For example, banks and non-banking financial companies, NBFCs, as a cumulative, all are called financial sectors. And for subsector, banks belongs to banking sector, and to that subsector, we can further divide that into public sector banks and private sector banks. Similarly, NBFCs can be divided into subsectors like real estate, consumer finance, and insurance. Again, to the consumer finance subsector, we can further divide that into long-term loan, short-term loan, or the payment company, etc. In that, the term loan can be further divided into like gold loan company or housing loan based or vehicle loan based. Likewise, for every company stock that we invest, first we need to understand the broader sector and then we need to dissect that broader sector into as much as possible into the subsector. Let's look at the example. Most of us know the company Muthoot Finance. Its broader sector is financial, then the subsector is NBFC, and the subsequent subsectors are consumer finances, short-term loan company who predominantly gold loan based. This is how we need to dissect it. So you might ask, why is this important? Well, first of all, to really understand a company like what they do, we need to understand the sector itself. This is because the way the whole sectors work affects all the companies in it. If any law changes or an additional new government tax or even for the government subsidiaries. Second, very important, the company valuations of each sector completely different from each other. For example, Britannia Industries at present trading at the P ratio of 50. If it drops to 30 or 35, then probably we can consider that as cheap and we can genuinely consider to invest in it. But the same 30 to 35 P ratio is very costly for oil or public sector bank. Again, we'll discuss all those in detail in valuation part, but my point is to understand how the company and the sector is related. This knowledge helps us to see why companies in different sectors will have different valuations and it have operated in different ways, which will lead to the question how to find the sector and the subsector of the company. Again, there are 3 ways to it. First one, looking at credit ratings of the company we want to analyze. Simply Google it, credit rating followed by the name of the company which we are interested in. For example, let's type in credit rating Britannia Industries. This search will show several ratings for the company. It's best to look at the most recent ones as they are updated regularly about every 1 or 2 months. But why do companies have credit rating? Like how when we borrow money from bank, the bank will do the credit check to assess our ability to pay back. Similarly, when company borrows money, any kind of debt, its ability to pay back that money needs to be assessed. This is where credit ratings comes in. These ratings varies with respect to each agency like A or AA or AAA. Higher the rating means the company got the more probability to pay back their debt. However, please be cautious with these ratings. They aren't always perfect or accurate since these ratings agencies had many issues in the past and usually when something bad happens, then they will tell us only after 2 or 3 months. So it's not an anticipation of the bad news, rather it's just a reaction. So I recommend don't focus too much on the rating. Rather, we use it just to understand the sector and subsector in it. Now let's look at the Britannia Industries credit rating. Here I'm just taking this one paragraph and reading it. Established market position in the domestic fast moving consumer goods FMCG industry. So the broader sector is FMCG. Then for the subsector, Britannia is a leading player in the Indian biscuit industry. Here, this biscuit industry is the important word. It's conveying 2 things. One, it belongs to the food company. So we have to value like a food company. In that, it's a biscuit. Here, biscuit means it's not a regular food. It's a long shelf life product like chocolates. So if there is no domestic competitor, then we can value with respect to international long shelf life food company like biscuit or chocolate or frozen food company. Again, valuation, we'll see those in detail in the valuation section. Here, please understand how to find the sector and subsector of the company. Again, repeating, Britannia Industries is a broader FMCG sector. In that, the first subsector is food industries, and in that, the further subsector is long shelf life food products, and further we can classify as biscuits. Here, the difference in the long shelf life food product is chocolate and frozen food requires refrigeration, whereas biscuits we don't need to. Hence, it's important, it reduces the operational cost and operational complexity. easily. That's one way of easy understanding how to find sector and subsector. Similarly, we can find all those in detail in the annual report, but a typical annual report will be anywhere between 200 pages, but most of them there is a special section in them called industry outlook or the market analysis kind of, where we can understand the sector and the subsector of the business. Then the third way of finding it is to listen what its management has to say. Here again, Google or YouTube search, just search for the name of the company and its top executives like MD or CEO. Most probably will likely find those top management interviews because they understand their business very well, knows inside out completely, and they must be a very good salesman. Hence, they explained it in a very simple way within 2 or 3 minutes. However, remember there is a catch. These MD or CEO, for that matter any top executives, often present their company in the simplest terms because their main motive is to sell the company to the investors. So their explanations are helpful, but it's important to be cautious. So these are the 3 ways we can use it to understanding the sector and subsector. Then second major part, analyzing the business model. Again, this section for any company, including the service sectors like IT companies, we can further divide that into suppliers who gives the input to the business, which creates the product, then how the product distributed to the customers. As a whole, what is their scalability? First, let's understand the supplier influence. Take the same Britannia Industries. We know their major product is biscuit and the main raw materials for that is wheat, sugar and milk. Again, we can see this also in credit report. For those raw materials, Britannia is at present dependent on external suppliers. So if the external suppliers increases the cost means, then we need to understand whether the business can transfer those increased price into customer or not. If so means, then how much of the percentage they can. Since Britannia can increase the price of the biscuit packet from 10 to 12 rupees easily, but not like 20 rupees per packet, especially if they have competitor who haven't increased means. I mean, in the first half of 2023, Britannia's biscuit raw material basket had the inflation of 32%. So they have to transfer those 32% into customers, but they can't. Since I think most of us know the main competitor for Britannia is Sunfeast, which is owned by ITC. And ITC do sell refined atta, and for that atta, they do have the agricultural business segment within. I mean, ITC grow the wheat, then convert that into refined atta, then sell those half of atta in their Ashirwad business and use the remaining for making biscuit, packet and sell it as a biscuit company. Hence, in ITC case, their major raw material is vertically integrated within the group. So there is no middleman and no profit margin reduction. So they are not in the same position as Britannia, which limits Britannia from transferring their whole raw material biscuit basket inflation. Similar to ITC in automobile sector, Tesla is very much vertically integrated. They mine lithium and cobalt raw material from Bolivia, then make the battery in their gigafactory and assemble it into the vehicle. In fact, they use their own in-house developed software for controlling the vehicle, like by controlling the powertrain module and ABS etc. Where this controlling software is huge expense for Audi, BMW and even for our M&M Mahindra & Mahindra. Except Tesla, almost all the automobile companies in the world are buying their controlling software from Bosch, and batteries either they buy from Samsung or from Cattle China. Because of those reasons, all the car OEM around the world struggle to attain the profit margin of even 10%, whereas Tesla can easily attain the profit margin of 25 to 30%. Another example, for Apple laptop, their own software, their own chip and their own graphics card, whereas for Dell, they buy chip from Intel, operating software from Windows and graphics card from Nvidia. And that's the reason similar price Apple laptop are far more or at least twice the superior value than the equivalently priced laptop from Dell. Here, I can give multiple examples like this. So the takeaway is, in order to analyze the business model, the first step is to understand the raw material supplier, like whether it's vertically integrated or at least how much control the business have over them, or at least whether they can able to transfer that to the customer or not. Then the second step in analyzing a business model is product and its scalability. Here, this is very simple for manufacturing. If it's a car company, car is the product. If it's a biscuit company, then biscuit biscuit is the product. That's very much direct. But the important point is to understand its interlink with the sector analysis. I mean, the whole analysis is interlinked to each other. I'm not denying that. But this product and its scalability is very much interlinked with sector analysis. Let me say why. In 2022, whole Indian biscuit market was just 3.2 billion US dollars, and as per Blue Wave Consulting in 2029, that expects to reach 4.07 billion US dollars. Meaning in Indian money, it's now roughly 30,000 crore rupees. That will increase roughly to 38,000 crore rupees. In that, at present, Britannia got 28% market share in India, meaning their revenue from biscuit on 2022 was around 8,000 crore rupees. So if they have only business segment, which is around 80% of their present revenue, their scalability is limited to 28% of 38,000 crore rupees, which is roughly just 10,500 crore rupees. From 8,500 crore rupees to 10,500 crore rupees revenue in 7 years, it's not great. And the Britannia management also know this. That's why they're exploring the other options in beverage segment, like launching the brand Come Alive. This is really important. I mean, many times we invest in the small companies and we think the company is going to become really big as a multi-bagger, but at the end it doesn't actually manage to grow since their business model or the product is not made to scale. The similar example in service sector, Muthoot Finance specialization is in giving gold loans. This means if we have gold, we can exchange it for a short-term loan. Hence, historically, most of Muthoot Finance business was concentrated in the southern part of India. Why? Because many people in the south more inclined to take gold loans. However, this business model had its limitations. Muthoot Finance found it very challenging to expand into northern India because gold loans were not as popular there. This limitation meant that their business model wasn't easily scalable beyond the south. Recognizing this, Muthoot Finance diversified their loan. They introduced home loans, which is a universal appealing product across India, whether in north, south, east or west. Everyone needs home loan at some point. Following this home loan, they added the vehicle finance, another widely needed service. This change in their business model marked a significant shift. I mean, even though their gold loan business was growing, it too had its bounds. By introducing new products like home and vehicle loans, Muthoot Finance significantly expanded its market reach. This expansion allowed them to scale up their operations even more. So when analyzing a company's product, especially a smaller one, it's important to consider whether it has the potential to scale its product or company got some plan to increase the product offering. A product with a scalable operation is more likely to grow, which in turn can lead to better returns. So we need to keep this in mind. While we are looking at a company, we have to look at its capability of different products, more importantly its growth potential. Then the final part of business model analysis is how strong their distribution network is, or at least what's their plan to improve it. I mean, if it's the established company, then how strong their distribution network is. If it's a new company, then what is their plan for the distribution network? See, we have the product, it's important to sell the product and it has to reach the customer's hand. For example, Britannia already got the biscuit distribution network. So for their new beverage business, they can simply use their existing one without any effort or the cost addition. Hence, that also one of the reason market is valuing at the higher premium. Since for the new entrant, it's not an easy job without reducing their profit margin, and establishing distribution network can be really expensive. Again, this is applicable for service company as well. For example, for the traditional bank, for their day-to-day operation, they have to run a lot of branches and also they have to set up lot of ATMs. All those will cost money and reduce the profit margin. But if we compare it with a new age bank or for the NBFCs, for expanding into a new area, they don't need much. All they need is proper and robust mobile app with one regional headquarters. That's it. They can expand it to the new territory. That's the thing we have to understand. What's their distribution and how efficient their distribution is when it reaches the customer. So that ends the analysis of business model. Just summarizing, divide the business model into three. Understand the supplier influence. Second, what is their product and its scalability. Third, understanding their distribution network and potential. Then comes to the final part of the video. What is the competitive advantage or the moat the company has? I mean, it is also really important. We need to know who the competitors are and what is the advantage of the stock we invest has over the competitors. Meaning, analyzing not just one company but also its competitors is important. Here, the competitive Competitive advantage can be anything. It may be low price, brand power, technological advantage, or maybe capital rotation, and more importantly, what strategy they have in place to keep the advantage. Let's take Prestige pressure cooker as an example. People recognize and trust the Prestige brand, so they might choose a Prestige cooker priced at 100 rupees over the lesser known local cheaper brand 80 rupees one. So here it's a brand power, and it is really important as it increases the profit margin. Again, I can say 100 examples for this: Apple iPhone or Coca-Cola or BMW, etc. Some way or the other, this brand builds the trust. Again, it can be anything, either through the quality of products or by strong marketing. Similar to brand power, what technology advantage they have? For example, a pharmaceutical company with a unique and patented drug has a clear advantage because customers has no other choice. They will have to buy from them, and no other company can offer the same product. Same way for low price, all Chinese mobiles, Redmi, Oppo, all have the strategy to offer at the low price. So having those competitive advantage is very important, and also equally important what strategy company have to maintain their competitive advantage. We know BlackBerry and Nokia mobile in 2010. At that time, both of them got all those competitive advantage like brand power and technological advantage, etc. But the advancement of Apple and Android OS destroyed those brands. Literally at present, both BlackBerry and Nokia don't have any competitive advantage. Now let's see the surveying brand. Nowadays for soda, predominantly all around the world, most people choose either Coke or Pepsi. Depends upon the taste which they prefer, and there are two main reasons for their choice. First, the quality of these sodas is widely recognized. Most people have tried both Coke and Pepsi and enjoyed their taste, leading them to choose these brands repeatedly. Then second most important reason is their marketing strategies to keep their brand image alive. I mean, both Coke and Pepsi always invest heavily in marketing in India through either on a cricket match or through the popular TV show. They always advertise with a strong film actor or the sports personality. Like everywhere we can find their ads, banners and TV commercials. Thus, this will make these brands highly visible and keeps familiar to us always. Their constant exposure reinforces their brand power. So that's their strategy to keep hold their competitive advantage. Similarly, for the stock we invest for the future. So having competitive advantage today is not an important thing. We need to understand what strategy the company have to keep their competitive advantage alive for our complete investment period. That's the end of this video. I think this is my longest video. I don't want to make multiple small videos which will destroy the purpose. Also, I will attach the framework Google document in the description. So when analyzing the stock, just populate those. I hope you find it useful and interesting. Just a disclaimer, don't make any investment based on this. This is just for educational purpose only. Please do consult your financial advisor before investing. Thanks for watching.